Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong life for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
All right, good morning, everyone. Welcome to Wealth Coffee Chats. It's Tuesday, 11th of Feb. My name's Danny McPherson. I'm from the Positive Tax team. So we're taking over the Tuesday morning slot. So I guess that means going forward, it's going to be Tax Tuesday. We'll be going through some of the latest topics, providing you with some great educational points and things to consider along your investment journey, all with a bit of a zesty tax flavour. All right, so give us a shout out in the chat too as we go along. If you've got any questions as we go, make sure you put them in. We want to make sure that you guys are getting as much out of it. All right, so make sure you got your a brew ready to go. We're going to get started. I'm going to quickly start with a quick disclaimer. So everything we speak about is general in nature and not specific advice. So make sure you speak to your professionals about the specific set of circumstances that you have and what's best for you. All right, let's dive into it. So today I'm going to be talking about trusts. Now, this is the most asked question I've had recently in the last few months anyway. Everyone's asking, should I be investing in a trust? Some people are saying it's going to increase my borrowing capacity. Morning, Rosie. How are we? However, like most things, it depends on your circumstances and where you're at with your investment journey. So using trusts for increased borrowing capacity is really just sort of scratching the surface. We haven't really got into any depth on what it's capable of. So the idea of today is to give you a bit of an overview of what a trust is, what they're used for, and the pros and cons. So hopefully after today you have some great questions to ask your professional team and see whether a trust is right for you. So anyone on this morning wondered if a trust is useful, thought about it? I'm sure you've heard people talk about it. Throw it up in the chat. Morning, Alison. So it's been a bit of a hot topic for a while now. So I guess the first thing to start off with is really understand what a trust is. So we define a trust being a legal arrangement where one party, called the trustee, holds and manages the assets for the benefit of another party, which we call the beneficiaries. So there's a little bit of terminology that we'll refer to, but these are the main two. And so the trustee of the trust is the person who manages it, and it can be either an individual or a company, and it acts in accordance with the terms set out in the trust deed. Now, this trust deed is the legal document that outlines the terms and conditions of the trust, including who the trustees are, their powers and duties, and who the beneficiaries are, and how assets should be managed and distributed. So I'll share with you, I guess, just sort of like a bit of a diagram. So this is, I guess, what we call a basic trust. So we've got the trustee at the top, individual or a company normally. and they're the ones that make decisions on the trust. The trust itself, and then also then it flows down through to the beneficiaries. So they can be individuals or also other entities as well, either companies or even other trusts. Now, when we talk about trusts, there are several types. So those being discretionary trusts or family trusts. So as the name suggests, you've got discretion on how income is distributed to the beneficiaries. We've got fixed trusts. Beneficiaries have a fixed interest in the trust, as specified in the deed. Unit trust. So this is a type of fixed trust where the beneficiaries hold units that represent a fixed portion of the trust. So that's similar to a company, I guess you'd say, in some respects. We have testamentary trusts. So these are established by will and coming into effect after a person's death. And then also superannuation trusts. So most of you will know about this as a self-managed super fund. So they're actually a type of trust. But for today, we're just going to focus on discretionary family trusts, as these make up more than 80% of trusts in Australia today. So that's what we'll focus on. So we might come back and refer to this at various points, just so you have a bit of an idea of what the flow through is. All right, so what are the reasons we might look at using a discretionary trust for investing? So I'm going to run through each of these in a bit of detail, but they are really just asset protection, tax minimisation and flexibility, increasing your borrowing capacity. So yes, that's on the list, and potentially also estate planning. Okay, so for asset protection, so in a discretionary trust, the assets are legally owned by the trust and not the beneficiaries. So that means that if a beneficiary faces financial difficulties, for example, bankruptcy, or they have a legal claim against their assets, the assets held in the trust are generally protected from creditors. Now, this is pretty powerful when a company is the trustee, because it gives that additional layer of legal protection, and super relevant for those who are self-employed or have businesses, where the risk is, I guess you would say, significantly greater than compared to someone who's on salary and wages or an employee. So an example where this might be useful is if you're a business owner who's got a business that's failed. For whatever reason, you've got multiple personal guarantees in place. So for the lease, potentially on the premises, for suppliers, items like that, if the investments are sitting in a trust, they're potentially shielded from any claims and not considered part of the business owner's personal assets, so potentially not at risk. So that's really powerful. Another reason you might use it is to help protect from family disputes. As the trustee has discretion to manage where the distribution from the trusts go, according to the trust deed, it does help protect from disputes. And most common scenario we've seen this for is where parents are helping their kids through different stages of life, whether that be sort of buying a house, paying for uni, trying to keep them protected from a future partner. So just discretionary trust can help in that scenario. One thing to note though, particularly where we have a couple that have a trust together with investments in there, the family court can see through this arrangement. So although there may be some legal separation between you and yourself, they may still end up in the pool of assets come a divorce settlement. So something maybe to note, we have seen that happen a fair bit recently as well. And they can also be used as a safeguard for vulnerable beneficiaries. So people who may have a disability or really financially inexperienced, the trustee can manage the assets in a way that ensures long-term well-being of those beneficiaries. So many legal reasons why you want to use a trust, and potentially getting a solicitor involved may help get you to meet your specific requirements on what you're trying to do. And it's usually a solicitor or lawyer that does draft up the trust deed as well. So there's a few professionals involved in creating a trust. Okay, so then we move over to the tax minimisation and flexibility. So a few fundamental things that we need to understand about how a trust works for tax purposes. So really important from a tax perspective, discretionary trusts are not considered separate legal entities. They're instead treated as a flow-through entity, meaning that the trust itself doesn't pay tax. So it distributes out the income to the beneficiaries each year, and then those beneficiaries report that income in their tax returns. Now, when we're talking about trust today, I'm trying to keep it very, I guess, it's a really complex area. So I'm trying to keep it as simple as possible today. So we're probably going over a few things here that are simplified, but I guess it should give you a really good idea of how they operate. So there is a potential that if the trust doesn't distribute to the beneficiaries, it may be taxed itself, like the trustee of the trust may be taxed itself at the top marginal rate. So we want to always avoid that. Now, people always ask, can I distribute to my kids? If they're under 18, they can only receive $416 before then they're taxed at higher rates, which makes it not worth it. And there are some rules about distributing to adult children where they must get the ultimate benefit of any distributions they receive. But I'm sure most parents are providing significant financial support to their adult kids, whether that be providing income, paying for uni, helping them get into their first investment. So heaps of options there. So also the same concept as well when a property is sold. So any capital gain gets distributed to the beneficiaries just as the income would. Now, good news still, if you're the beneficiary and you're an individual, you still get the 50% CGT discount. So that sounds pretty appealing. I have options to stream the income as well as the capital gains tax effectively to whoever, I guess, is on the better marginal tax rate. So does that sound appealing? Make sense? Pop it in the chat along with any other questions that you've got. Sharon, I've got a question here. If I've already built my property portfolio, my individual name, what can I do now to help with the handover to my children when I die? Yeah, so Sharon, I guess that would probably be something to look at potentially like in a testamentary trust that's created on death. I mean, to use a discretionary trust, we'd probably like to get it in there before something happens. But a testamentary trust might be something that you would want to look into. Thanks, Sharon. All right, so I guess that sort of covers the streaming of income and gains. But let's consider if an investment property is negatively geared. So our expenses are more than our income. What happens to this loss amount? So pretty common scenario, we have negatively geared property. Usually for a property owned in our own name, I'm sure we know, we get to offset this loss against our other income, therefore saving us tax. However, in a trust, we can't distribute that loss and it's contained within the trust for use against future income. So this can cause a bit of a problem for those who are on wages particularly, and they're not getting the tax benefit now. And this is where it's really important to understand the profile of the property and how long you expect it to be negatively geared for. Now, when I say negatively geared, we're including depreciation as well. So not just looking at cash flow, but from a tax perspective. You would almost say if it's only going to be a year or two negatively geared, then potentially in the longer term, where we got flexibility to distribute to other beneficiaries at a lower tax rate, it's going to be worth it. But if it's going to be longer, we need to consider the cash flow implications on still we've got to service the debt without that tax benefit if it's sitting in a trust. A couple of ways around this would be have other assets sit in the trust that generate income and can offset this loss. So you might have a share portfolio in there. The dividends offset that. And for business owners, it is a lot easier. We have a lot more flexibility, particularly if you're structured correctly on utilising this loss within the trust. So this inability to distribute losses can be a significant downside to trusts, particularly for those on salary and wages. And some other potential drawbacks are the additional costs as well. So we've got costs to set up, ongoing administration and professional fees. So this might be ASIC and your accounting and tax returns need to be done. And then, yes, we've got a question here. Sanjeev, is the trust threshold for land tax low? Yes. So that is another downside, is that in some states, they will whack you with land tax on trust property where if you were in your own name, it may not. So that's something to consider. And all of these items need to be considered, I guess, when you're weighing up whether to go through a trust. So it's really a long-term decision, I guess. As we all know, the investment journey is a marathon, not a sprint. And making these decisions need to be, I guess, made with a long term in mind. A question from Courtney here: if you transfer a property from personal name into a trust, will that incur CGT? Unfortunately, yes, is going to be the answer most of the time. It's treated as basically a CGT event and a sale across. So basically a sale from you to the trust. So I guess you're going to have potentially realizing the gain, and then I guess also stamp duty on top of that. So, I mean, sometimes it might be the case where we do that, but other times it may not be worth the additional costs. Perfect. So we've gone through asset protection, tax minimisation, and flexibility. Now we come to increasing your borrowing capacity. Now, Kang did a Wealth Coffee Chat a couple of months ago on this, so make sure you go back and have a look. But in a nutshell, if the trust is neutral or positive, some lenders won't count this towards your borrowing against you personally. So, in effect, they're almost just basically forgetting that you've got that loan or that property. So that can be really powerful. I know we just went through a refinance on our residential stuff, and then our commercial stuff that's held in trusts, they don't even look at. So it does make it easier when it comes to getting the loan as well. So ultimately, if circumstances and strategy align, there are significant benefits of having a trust. It means being able to minimise tax through the holding period, potentially on the sale, and also giving you the legal protection as well, and potentially removing a bit of that borrowing cap that a lot of us are hitting at the moment. Perfect. All good. Thank you very much, everyone. Now we've got a email down below, so if you have any topics that you really want covered, make sure you send us an email with some suggestions. Thanks very much. Enjoy the rest of your Tuesday, and we'll talk to you next week. Thanks, guys. See ya.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at positivementor.com.au.